Welcome, everybody. So, for those who are new to the REI Genius, our $1 million coffee hour, I'm Johnny Lynum, the founder of REI Genius, military veteran turned full-time real estate investor and educator. I'll say real estate investor maybe 12, 13 years ago when I bought my first true rental property back in 2013, and then, started as a fix and flipper in 2015 and got into commercial space in 2020. And now, today, we're going to really be talking about the accredited investor blueprint. So, three powerful, actionable strategies that high income professionals, veterans are using right now to build tax efficient cash flow and to protect their wealth. So, strategy number one, so direct ownership of multifamily real estate. One of the, I would say, blue chips when it comes to cash flow in real estate. We all know, traditional single family rental properties. And for me, that was the process that I started with my journey with leveraging my VA loan. And from there, when I PCSed or moved to a new duty station, guess what? That previous primary residence that I bought 100% financing with the VA, didn't have to put any money down. Now it converts to a rental property. And I did that, consecutively three times. And after the third time, I was like, okay, let's look at doing this more frequent and become a true investor now that we're built up a portfolio. And so, going down that path, we eventually got into fix and flips in 2015, started keeping every couple houses. We would hold back and kind of do the bird strategy where we would buy, renovate, rent it out, refinance it, then repeat and do it all over again and keep those as rentals and have instant equity and cash flow. That was a good model. It helped defer some of the taxes. But in 2017, with the tax act that was passed, it brought a thing called 100% bonus depreciation into play, which changed the landscape with commercial real estate, where it allowed you to accelerate all the depreciation that had a schedule of under 20 years. Then you could take all that depreciation in the very first year of ownership all at one time. And I'll show an example of what that looked like with my first 18 unit. But one of the things with multifamily, on top of just the tax strategies, is the cash flow. You have more units, more income. If you have one vacancy, guess what? You have more units that are still cash flowing, that still paying you each month, still paying their rent while you have one unit down. Because guess what? One thing that I learned with only having like one rental property, that once you have a vacancy and somebody moves out, you go from 100% occupied to 0% occupied really quick. And when you have two properties, you go from 100% to 50%, which is still not ideal. And so being able to go into multifamily units that you're able to achieve those economies of scale, you're able to protect your cash flow and not have those large perturbations in your cash flow when someone moves out and when someone vacates the property. But the other great advantages, that come with multifamily is the long-term appreciation. And, I tell my clients all the time, and I talk about, our first multifamily that I bought in 2020. In less than 2 years, we had our initial cost basis of $1,050,000, and in 2 years it appraised for 1.76 million. And we only put about $70,000 worth of renovations in it. And that whole story where 50,000 of that came from the insurance company because we assumed the insurance claim when we bought it from the previous owner because there was still work that had to be done. And it just allows you to now improve the value. So great benefits of having direct multifamily ownership can directly have a bottom line impact to your portfolio, the cash flow that you're able to bring in on a monthly basis, and it appreciates with time. We all know real estate is a great hedge against inflation. We saw it right after COVID that inflation spiked. The government, we printed trillions of dollars. There was, I think we with three kids, I think I may end up getting like over $7,000 in stimulus checks during that period of time. And so with that, there was a lot of money that was printed from the Federal Reserve. And guess what? When you print a lot of money, inflation goes up. And so we saw that real estate is a true hedge against inflation, where we see those who own property over the last 4 years that anywhere from 30 to 40% easily appreciation in the value of your home. Just because it was a hedge against inflation, it's going to take more of those dollars that they're printing more of to buy your property, your asset. And so that's the thing that we see here with multifamily, that it's a great hedge against inflation. In this example here, so going into my first multifamily that I was sharing, we bought it for $1,050,000, the down payment, $210,000. And our first year bonus depreciation was $186,000. So essentially, if I took $210,000 from my gross income from that year and I put it as a down payment buying this 18 unit that, oh, by the way, that produced $15,000 a month. The mortgage payment on it was $4,400 for the principal and interest. And then insurance was about 600, I would say closer to $700 a month. And then taxes were about the same, about $700-800 a month for this property. So all in a little bit less than $6,000 on a monthly interest, principal, interest, tax, and insurance payment, just like you would have for your mortgage. A little bit less than 6,000, but the property was producing 15K each month. And so with that, putting $210,000 down, I can wipe out nearly over 90% of that in the first year just because of bonus depreciation. And then I think we're getting around $30,000 of depreciation each year after the very first year. And so this is how it breaks down. You can't depreciate land. And so the percentage of the land that was allocated, you can see there 84K. The building cost over 27 and a half years. We couldn't deduct all of that in year one. So that was spread out over 27 and a half years. But then everything that was below 20 years, 5 year and 15-year property was all able to be depreciated in that very first year, which came to that 186K.